What is inducement and how can you use it to win more and lose less? Let's take a look. So before we start looking at any live chart examples, I want to break down the concept of inducement for you to show you why you need to be aware of it and how it can save you a lot of money by understanding this concept. And as well as saving you from losses, it will also allow you to catch some brilliant trades. So what you can see here on the chart is pretty much an explanation of what inducement is going to look like. Now, what we have here is a downtrend with two supply zones. Now, a lot of people will look towards this supply zone here to actually sell the market when price comes into that area. So we know at this supply, there's going to be a lot of sell orders waiting for us. However, this zone is very often what we call an inducement zone. It's an area that attracts sellers before price takes out the level and moves higher into another zone before moving in the right direction, just like what you can see on the screen. Many traders will put this down as an unlucky loss, but it's not. There's a lot of logic behind this setup, and we can actually trade this in a way that will benefit us massively long-term in our technical trading. So how exactly do we work out whether a zone is a true zone or an inducement zone? Well, this comes down to two big things. First of all is liquidity. Second of all is imbalance. So as you can see in this example, I did actually mark on here that there is an imbalance between this supply and this supply, meaning that there's some open space which hasn't been filled in by price. If the market had pulled all the way up and filled this imbalance, then this for sure would be the right point to sell from. But because we actually have price action a little bit like this, where the market didn't fill the imbalance, what that actually does is leave some open space that the market is going to want to fill. This is where the inducement comes in. Now, inducements will be even more easy to spot when there is liquidity. So let's say there was a series of equal highs at this level. Well, that's going to lead us to understand that this is not a high probability area to trade from because price is likely going to take out these stops. If we look at inducement from a liquidity point of view, liquidity is basically stop loss orders or stop orders in the market. If we know the majority of people are going to be selling from this point, we know the stop losses are going to be here. So price is going to reach for those stop losses to trade into the real point of reaction before the sell-off kicks in. And those are the two key ways to spot inducement in the markets. So now I'm going to take you over to the charts and show you two live examples so that you can get to grips with what it looks like in a real trading scenario. Hold up, before we get into the real chart examples, I have a free 70-minute training that you can check out right now. We go over a whole different bunch of charts and concepts that are keeping you from winning and show you how you can change your perspective to become a winning trader. So check the link out in the description and join that there. So here we have an example of inducement in a live trading scenario. As you can see, we have lower highs forming continually in this market and a break of structure which has just led us into a new downtrend. Now, looking at this structure, a lot of people will actually see this area here as a supply zone to sell from once price comes into it. The problem is, however, there is imbalance above, which leads us into this supply just here. And this therefore acts as an inducement zone for the true zone, which is just above in this price point here. And as you can see, I've just marked on this small imbalance, which leads through into this larger price area. Now, another thing to note is that we have these almost equal highs in this price area here, which will act as a little form of liquidity, leading us towards that point. So what we would anticipate based on the inducement is not a reaction from this zone, but instead a reaction from this one above. And why is that? Well, here we have a clear supply, so we know there are going to be a lot of sellers within this point with stops over the high here, but we can also see that there is equal high liquidity and an imbalance which leads us through to this point. And if we look previous to this, we have absolutely no imbalance left. So this is surely the right point to sell from. Okay, we have this supply here, which has been retested by this candle. We then have this supply here, which has been retested by this candle, and that formed this supply, which as you can see, has not yet been retested. So that is how we understand by using the imbalances in the market, whether we are looking at the true zone or not. Because obviously this could be an inducement zone, but if there was further imbalance up here, potentially this could be as well. So if we were looking to trade this piece of price action, our setup would look something like this. We could look to enter from the true zone with a stop loss above and then target down simply to the lows because we know we're in a downtrend and we are likely to go and tackle that point and move into further downside price action. And as you can see, by allowing the market to play out, that is exactly what happened. Now, one final note before we close up the video. You can actually get into inducement-based trades using confirmation entry approaches. One did form on this setup. It's not always going to form on every single setup. That's the risk you take when you go with confirmation entries, but I'll show you how that would have worked here if you need that extra layer of confirmation to place on your trades. So for this setup, the initial reaction would have happened at this point here. But as you can see, we then had this sell-off, which was where the break of structure started to come in and confirm the downside shift from the inducement zone. So what we could do is identify an area of supply, which in this case would be this area here, and then we could place our sell limits from there. Because what we now have is the inducement zone taken out, the real zone retested, and now a sell-off which has confirmed that the low time frame structure agrees with the high time frame picture that we had in mind. So the confirmation-based approach would look something like this, and yes, it has lower risk reward than the initial risk entry, but it's still a solid trade. And if you're a trader who needs that extra layer of confirmation, there is absolutely nothing wrong with taking this version of the trade. And that's it. It's quite simple to actually understand, identify, and trade inducements when you are aware of them actually happening. Most people don't know that this happens, so they write off their losses as simple misfortunes, when really a lot of trades could actually be broken down further, looked at from a liquidity perspective, and understood that actually the zone you were selling from or buying from initially is an inducement zone. So what I would advise you to do now is go to your charts and backtest this. You'll notice many different examples of inducement happening on a daily basis across the pairs that you trade. And by the way, inducement occurs just as much on the high time frames as it does on the low time frames. If you remember back to a couple of weeks ago, I made a video on the setup that me and my team took on EuroGBP, which was taken from a sweep of this liquidity. The trade came through and filled into this area here before moving away. And this, in this instance, was the inducement zone, and this was the true zone. And that setup ended something a little like this. So that's all from today's video. I hope you learned a new lesson. Thank you for watching, and I'll see you in the next one.